Thank you very much for that. Yes, indeed, I have the Department of Economic Affairs Secretary and leading the Indian delegation here, Mr. Subhash Chandra Garg, here with us. Thank you very much, sir.
Thank you.
IMF meets in Bali and all of that, I think it's important to talk about the problems back home and that the world is facing. We all woke up to a market crash of nearly 1,000 points. The Dow had crashed overnight. Is there a sense of what is really happening? Because many people are worried now with the kind of value erosion that's happening, the market cap that is being lost. Is there a sense of what is happening? The outflows is something that Madam Lagarde talked about earlier in the day today as far as India is concerned. Are you at all nervous with the equity and the currency market action just yet?
So you said the annual meeting context, it's indeed global. You come here to discuss the global issues. Obviously, the country is behind the discussion all the time because we look at all our participation in these international events from the perspective of what India has to do, gain, loss or something. The today's semi-meltdown kind of thing is also a global phenomenon. So it started with the Dow yesterday in America, which lost quite a bit. Essentially, it seems that there is that kind of slight bit of flight to safety. There was perception that the inflation in US would go higher. If it goes higher, then the Fed might raise further rates, and which might lead to yields further hardening. And in that situation, there is some flight from the equity markets to the debt markets, and that is what possibly explains the yesterday's Dow behavior, which then got on to Asia
and then India.
And the immediate impact was seen in the morning. I understand now there is some recovery in the market, there is some stabilization. People will realize that the concern may not be as big and as serious. And that is what it is.
But Mr. Garg, the reality is that the US economy is on the upswing. Unemployment numbers are coming down. Inflation is rising. Obviously, the central bank there is going to raise rates going forward. What can we then do to at least contain the FPI outflows that we are seeing? Because that's primarily the reason why our markets are crashing.
So, more than the US economic growth, which possibly is more funded by the debt and the taxpayer, I think it's a little bit nervousness about the inflation, which no one likes, and therefore the Fed's behavior, Fed's decision to take action on the rate front and potential. That seems to be more driving force. And if relatively, but at some point in time, the flows into the US will drive the supply much higher than the demand is, and which must bring the rates to a more normal level. So it can't go on for long.
Perhaps it's going to happen over some course of time, but I think I need to ask you a question on the rupee. And while you've been on record to say that there is nothing seemingly to worry because we've got good forex reserves, the currency markets don't seem to be listening to the government. I know we are a part of the global economy, there's a global contagion, all emerging market currencies are down, but we are the worst performers as far as the peers is concerned. At what level will the red flags go up, the alarm bells go up? We're already staring at 75. Is that a psychological mark? Because every 70 seems to be a psychological mark now. Are the markets not listening to the government or the RBI? I mean, what is happening here? And also, if I may ask you a question, you've taken a series of reforms to resurrect the rupee. The RBI also intervenes in the markets. But why are you not looking at things like an NRI bond or a single window for OMCs? Is that on the anvil?
See, I don't think this is a correct characterization that the government has not been worried about. The slide in the rupee, it has. That's why it has taken several measures. Why did we take all the measures in the current account, also in the capital account was taken because there was a perception that the slide is too sudden, too much, and therefore we need to do take measures all on current account, capital account, everywhere. The one you referred about, the NRI bonds and all, is further to the capital account measures when the reserves fall to levels or there is an apprehension that we need to buttress the reserves.
And that's not happened just yet.
It has never been said that we will not resort to that. We have always said that this is an option which will be exercised whenever the time comes.
How much of a play is the liquidity in the markets as far as currency markets is concerned? There is, I mean, besides the global contagion, besides the equity markets falling the world over, in our own market, one fear that seems to be gripping participants is a liquidity scare. I know the SBI has said things on NBFC and you welcome that move, but as far as liquidity is concerned, how are you going to assuage frayed nerves?
So, by the way, when the Reserve Bank sells some reserves to support rupee or to bring orderliness in the market, it drives the liquidity down.
Sure, yes.
It sucks the liquidity away. And therefore you have to do OMO and other things which the RBI is doing. The other reason why there was a liquidity crunch, and that's more specifically to a segment of the market, which is the NBFC and HFCs. There is no liquidity issue for the banks and the other financial market system. It's basically, and that's where we need to address it. The step taken by the State Bank of India to create that facility did have a very good effect yesterday.
Yes.
Some more measures would come. So we have to be taking measures which address the wider market liquidity as well as the specific segment. And that I think will happen and is happening.
I will ask you for some indulgence because one of the things that we are picking up in the markets is that the NBFCs may be allowed to borrow money through the ECB route at all. Is that wide speculation or is that something that's on the anvil?
And NBFCs are allowed even today to borrow through the ECB route. There's no bar.
Okay, so that's a clarification that I wanted. But sir, there is a review of norms that the government is likely to do on NBFCs, and I was having this conversation with former RBI Governor Y.V. Reddy here yesterday, and he said even as the government reviews norms, there needs to be a larger distinction made between deposit-taking NBFCs and non-deposit taking. I mean, will you be on board with a view like that?
No, this is the regulatory aspect which the Reserve Bank has been handling from some time to time. Regulations have been strengthened and made more rigorous for the deposit-taking NBFCs than for the non-depositing. Because they don't pose that much of the systemic risk. I don't think at this moment there is anything afoot about further regulatory aspect to it. I don't think the time is also there for this. I haven't heard anything major on this.
Okay. Two quick questions on macros, and I will begin with fisc first and then talk about current account. On the fiscal front, the government has been very responsible, and I think the one green on your report card is fisc and the fuel reforms. Markets are wary that you're slipping on both, and if I may voice a concern that we get up from market participants is, as far as the fisc is concerned, Moody's now says with oil prices going up and now OMC is having to absorb the government cutting excise, there will be a larger implication on fiscal consolidation. 3.3% looks challenging. From a policy point of view, is it challenging? Is 3.4 likely? Or are you someone who's not going to be overly worried about the last decimal point?
See, I think anybody would always see this kind of price rise in the oil as a major threat to the fiscal target, right? In the fiscal management. And I don't blame Moody's or others. But I would like you to appreciate that the government has been far more sanguine. The government has been far more clearer in handling the oil price to see and to repeatedly reaffirm that as far as the fiscal deficit is concerned, we will not make any compromise. And there is no danger to my mind, even after that 2.5 rupees kind of reduction which was brought in last couple of days. Our fisc is in completely manageable situation.
But the big fear now is, will you go for expenditure cuts? So that's the other big fear that's now coming to the fore, especially after you've reduced the borrowing target.
The finance minister has said very clearly there is no move to reduce anything on the expenditure side to meet any potential shortfall on revenue.
Okay.
Because we don't expect at this stage any significant shortfall on revenue, right? And therefore there is no deliberate attempt or decision to reduce any particular kind of expenditure. Always, every year, there is some natural reduction. Not everyone spends fully the budget allocated quotas, etc.
Yes.
That might come in, but that would be not a policy driven decision or any specific decision.
And that could have happened any financial year.
Any
Two questions before I let you go. I know you've set up a meeting to speak to us. One has to be on the current account deficit, and the other emanates from that. On the current account deficit, at levels of nearly 2.8, 2.9 or even 3%, how worrying is that as far as our external trade is concerned? That was a vulnerability. It ceased to be a vulnerability. It looks like it's a fault line once again.
See, the current account 2% level is considered absolutely healthy for the developing countries like us. We need global savings to come. Current account deficit of 2% represents global savings coming to India. That is perfectly fine. Going to 3% will add some cause of worry, which we are in a position to manage. A lot of measures have been taken. The problem starts if you are not able to finance the current account.
That's right, yes.
Deficit. But our FDI flows have been very strong, continues to be very stable. So we don't expect the current account financing to be extremely difficult and big. And therefore, that's what is going on. And I don't expect this year to end beyond 3% in any case.
Okay.
And therefore, I think we have
and is 3% a level that we should be comfortable with?
We can manage.
Okay.
We would obviously like it to be around 2%. But if it goes to 3%, still it's manageable for us.
So because we are talking in market hours, and I think market participants often watch you like a hawk to see what you have to say. As far as divestment is concerned, very ambitious targets were put on the table, and there was a big thumbs up that happened during the budget. But increasingly, is it looking tougher to achieve those targets because we're in a weak market? You obviously can't be selling stocks when they're not going to meet their real value. What is the way out? And the reason why I'm asking this question is not just divestment, because revenue from GST is still not what you would want it to be. As far as divestment is concerned, there's some amount of uncertainty there on that front.
The divestment 80,000 crores target was very reasonable, ambitious enough but reasonable to achieve. We have a plan for achieving it. There is some difficulty. I wouldn't say that it's not, because of the correction which has been seen in the past couple of days. But if we believe that this correction is temporary, I think we will come back to our path of making divestment using the market as well.
So how much of that 80,000 crore do you believe is going to be achievable if these conditions
we are keeping it at 8,000 crores at this moment. No change in that.
No change in that. A quick last question, and I think that's a question that some people here have asked, and some people have also volunteered to answer, and I'll quote YB Reddy once again. And on ILFS, while you're doing all it takes to keep the institution afloat, you will perhaps see some entities sell off. As far as the larger systemic risk is concerned, more than ILFS, is the systemic risk more on account of the fact that the risk control mechanisms of LIC and SBI weren't being able to detect what was happening at ILFS? I mean, why did the government have to step in when you had institutions like these?
ILFS was in the infrastructure space. Infrastructure space is a bit difficult space. They were doing a lot of good work and a lot of progress which India has made in privatization of infrastructure on PPP mode and all is also attributable to the initiatives taken in ILFS. There have been several changes of very significant import, Land Acquisition Act, other things which took place. So that affected the ILFS model, especially the model which comes through the NBFC route. And that created some problems in the ILFS management of assets and liabilities. I would wonder the LICs and the SBI and the other board members might have got some sense of the difficulty, but they perhaps couldn't gauge that the problem is becoming serious enough for requiring some more serious steps. And since they did not act in that particular way, and they were, as the equity owners, as the shareholders, would have possibly taken those steps to do it.
Yes.
But when the problem became somewhat bigger than what they could have handled, the government had to come in and bring in by creating a new board, and hopefully we will resolve this.
One last question. You have had a big green on your report card as far as fuel deregulation was concerned. There are now fears, are you turning your back on fuel deregulation?
Not at all.
I know you're not doing that, and I know you would have said this. Will OMCs go back to hiking prices this cycle?
They are already doing. It's not that they are not doing it.
So that 1 rupee fall.
That was at that particular point of time the reduction was made. But as per the formula, if subsequent increases are required, those would be done. And hopefully this this hit which they are taking will be absorbed against their valuation gain this time. This shouldn't be affecting.
But what is the guarantee you will not go back to doing this when oil prices rise again? That is what markets are worried about.
I think that's since we had some sense that there are some valuations gains etc. and they can absorb this, and therefore this was. But the government's commitment is complete. No going back on the deregulation. This is what would work.
On that note, sir, thank you very much for speaking to us. That's Mr. Subhash Chandra Garg, India's Department of Economic Affairs Secretary, speaking to us right here in Bali at the IMF Summit.